So have you ever bought a bank Nifty option and suddenly the market moves in the exact opposite direction? Well, you might have been playing against a giant. So according to SEBI, a US-based trading firm called Jane Street made over 36,000 crores from the Indian stock markets without breaking a single law. So this is not a scam in the traditional sense. So this is a legal, systematic move using money, psychology, and timing. So let's see who is Jane Street. So Jane Street is a quantitative trading firm based in the US. It was founded in 2000. So they are big, very big, managing billions of dollars in daily trades with operations across New York, London, and Hong Kong, and yes, India. So they basically specialize in high frequency trading, arbitrage, and derivatives. So you probably never see their name, but they are often behind ETF liquidity and index trades. So in India, they were one of the FPIs, so foreign portfolio investors who are operating quietly until 2 days back when this investigation happened. So prior to that, most of the people who are operating in Dalal Street, investors, traders, they do not know who Jane Street is. But in the last 2 days, this name is becoming very popular all over the country and across the market pundits. So let's break this down, how they pull this off using some real examples. So Jane Street would pick high-weighted stocks in the Bank Nifty index, like HDFC, which has over 25% weightage. So similarly, ICICI Bank again has over 25% weightage. So overall, just HDFC Bank and ICICI Bank together constitute more than 50 percentage of weightage in the Bank Nifty index. So this is something that can basically move the entire index if they can move these two stocks, because this is 50% plus weightage. So even if other banking stocks fall or rise, it doesn't matter. If you can move these two stock prices, then the Bank Nifty index itself would move. So let's see how the index got moved where they were able to make money with a simple example. So what would happen in a typical journey? So the pump generally begins. So Jane Street moves the market. So on Monday or Tuesday of an expiry week or a monthly expiry week, HDFC Bank's price would be at 1515 the start of the week on Monday. So they'll buy several crores worth shares of HDFC Bank and ICICI Bank, and the prices would move from 1550 to 1595. ICICI Bank's price can move from 980 to 1010, and Bank Nifty can move from 49,000 to 50,300. So what's happening here is they are buying at decent price, and they are making 3 to 4% profits here on top of hundreds of crores of money by buying direct shares. Now, what happens among traders, people who are looking at technical charts? So they find this to be a breakout, a rally. So all those green candles, all those hot technical indicators, AVWAP, DMA, 200-day DMA, 50-day DMA. It has crossed R1, it has crossed R2. So it has become strongly bullish. So there is a breakout. So using all those jargons, all those technical indicators, people find that this is a clear breakout. And so this stock is basically the bank index, Nifty index is likely to go up, and they start purchasing heavily at this price point, 50,300. Now, what does Jane Street do? So before that, people start buying. So what happens is the call price, 51,000 call, would have moved from here to here. There is a movement. So it would have moved from 120 to 170. So some even buy 52,000 call for a cheaper option. So 52,000 call could be available at 30, 40 or 50 rupees. So they would have purchased them, and given that Bank Nifty lots are pretty high, they buy all of these things expecting a breakout, and the bank Nifty index to further go up so that these premiums of these call options would also rise and they could make profits. So that is why a lot of retail traders would buy these bank Nifty options. So what happens next? By Wednesday or Thursday, what does Chain Street do? Just before expiry. So they start selling the same stocks. So when they start selling huge quantities, so the volume is high, they sell crores of shares worth crores of rupees. So HDFC Bank drops from 1595 to 1530. ICICI Bank drops to 960 rupees. Now Bank Nifty, which was basically at you can say 50,300. So it was at 50,300. Now it collapses 1,500 points to 48,800. So your calls become worthless. So whatever retail traders purchased 51,000 call at 170, it becomes worthless. 90 to 95% would be lost. You'll end up selling it at 17 rupees or 20 rupees or 25 rupees. So you lose all your premium and you lose huge money. So even a small amount is huge for retail traders. So this is like 90 to 95% of your capital getting wiped out in a single day, single trading day. So what does Jane Street do? They make money by buying HDFC shares, ICICI shares in cash market at a low price and then selling it at 3 to 4% gains on hundreds of crores. First thing. So they are not just buying and selling stocks. They are also doing one more thing. When the prices hit the rooftop, so when prices crossed 50,300, they start shorting the bank Nifty. So they purchase put options, and then they also short the futures contract. So what happens here? So the bank Nifty 50,000 P, they would purchase it at 180 rupees when the bank Nifty was trading at 50,300. Now it is at 180. When they start dumping the shares of HDFC and ICICI, Bank Nifty would start going down to 48,800 from 50,300. So this 50,000 P would move from 180 rupees to 700 rupees. So what happens? There are three positive things for Jane Street here. So they made short-term gains on stock trading, number one. Number two, they profited on index derivatives. Put options moved from 180 to 700. Similarly, their futures would have returned 5x to 6x returns. So they used their own volume, their own capital to trigger retail's FOMO. So this is a typical manipulation where stock prices, index prices would move, and then when everyone, especially the retail traders, when they believe that there is a breakout or there is a huge fall that is expected because it has crossed the support level 1, support level 2, because of which they buy put options. If it has crossed first resistance or second resistance, or if it has turned bullish on super trends, or there are tons of indicators, or even your reverse head and shoulders. Now it's bullish. So all these things can basically trigger a FOMO, and the retail investors start buying in the fear of missing out on a profitable trade. So that's what happens here, and because of which they lose a lot of capital, and all of this money is pocketed by Jane Street. So what is Jane Street doing is technically not illegal. So what they are doing here is they are not just buying and selling stocks. This is actually not a pump and dump. So it is a controlled trade setup. It could be an algorithmic trading which has been trained or coded in such a manner. So it is basically you are fighting against bots, you are fighting against machines, you are fighting against people with huge tons and tons of cash, billions of dollars cash worth. Institutional investors are trading against you. So that is why you see 93% traders are losing money in India based on a SEBI stat. So unless you know these mechanics, these controlled trade setups look normal, but still, basically, technically, it is not illegal at all. So between Jan 2023 and March 2025, SEBI reports show this pattern has been repeated multiple times, especially during weekly expiries and also during major events like RBI events or Fed rate announcements or any other banking related important events like results, for example, HDFC ICICI Bank results. Typically, if the results are really good, the stock price would obviously go up, but they might try to keep it low and make more money here through put options. So, how much total profit they have made? So, it is estimated that they have made around 36,000 plus crore profit. So, basically, trading is a zero sum game. So, where the money goes from the weak hands to the smart hands. So, smart institutional investors and traders basically get all the money from gullible retail traders. So, this is typically what happens. In trading, most of the traders lose money on the retail end. Only a few percentage of retail traders who follow a proper framework, who has a very, very highly disciplined approach, who has a lot of experience and skill set, they are the only ones who are profitable. Very few, maybe 0.1 percentage of retail traders are 0.5% maybe profitable or break even. That's how it is. So SEBI is not accusing them of fraud, but is now reviewing whether regulations have to change. So why retail traders lose? Most people blame themselves, but the truth is you are actually not losing because you are wrong. You are losing because someone had more capital, someone had better timing, someone had the ability to move the market, move the index itself with huge money. So this is why indicators, chart patterns, or trend lines, they often fail because the market is not a neutral game. So it is highly inefficient. The ones with money, they can influence index, they can influence stock prices. That is why it makes sense to not do trading. Even if you want to trade, you should trade with just one percentage of your capital, so that even if you lose that money, your portfolio is protected really well. So what Jane Street did is not technically illegal. So they used public exchanges. So they did not hide trades. They did not use insider info as well. So, but this opens up a key question. So this is something that SEBI is looking into. Should players be allowed to influence the index levels this easily? So does this provide an even playing field for retail traders to trade in the market? So SEBI is now reviewing the FPI algorithm trading rules, especially on index related manipulation. So again, this is just a tip of the iceberg. We know only one story about Bank Nifty. I'm sure there are tons of stories that can come out in Nifty index, manipulation in Nifty. All these things can come out if these kind of complaints come up. So this happened because one guy went to the SEBI office and raised a complaint himself manually. So hope more such things come out and we have an efficient trading ecosystem which will make it healthy for even retail traders to participate and make some money in trading. So for you and me, the takeaway is very simple. So this fiasco, the story is telling us, do not chase sudden rallies blindly. And number two, understand who is moving the price. Is it happening fundamentally, organically? Is it happening technically, or is there a big trader who is moving it just for his own gains? So avoid expiry day F&O. If the odds are basically designed to trap you, unless you want to trade with 0.1 percentage of your capital. If you want to trade on an expiry day, trade with a very limited capital, you should be open to lose that money. So basically, this is not a call to fear the market, it is a call to respect it. So basically, because behind every candle, there might be someone like Jane Street holding the matchstick. They lit fire, and your green candle or a red candle would go bust. So, one final reminder that is learned through this is always treat trading as a speculation, so not investing. So, never risk more than 1% of your capital in trading. So never put more than 1% of your capital on a single trade. So because in a market where giants have so much access to capital, where they can basically move the index wherever they want, as a small time investor, you should not be risking too much of your hard-earned money. End of the day, capital protection is the most important focus that has to be there for us. So yeah, that sums up this video. Lots of learnings from this particular case study. So hit the like button if you learned something new, and subscribe for more real stories from the world of finance. So let's build wealth together. Subscribe to our channel Investing Gurukul. Thank you. Have a great day.